Thank you, Commissioner Campbell. I'm Anthony Becker, Minnesota State Economist. Since Minnesota's budget and economic forecast was last prepared in November 2025, the U.S. economic outlook has improved slightly, with higher rates of growth in real gross domestic product, consumer expenditures, and investment, along with a forecast for slightly lower rates of inflation in the near term. However, payroll growth has weakened and trade policy uncertainty continues to cloud the economic outlook. Our macroeconomic consultant, S&P Global Market Intelligence, SPGMI, released their baseline forecast to us on February 6, 2026. Due to the federal government shutdown in October and November and the partial shutdown in early February, certain key data that are typically available for SPGMI's February forecast were not available to them. The data include fourth quarter gross domestic product and its components, corporate profits, and the January 2026 employment situation report. Also missing are consumer prices from October of 2025. On trade, SPGMI assumed an effective tariff rate of 14%, 4 percentage points lower than in November. The recent Supreme Court decision invalidating the IEEPA tariffs happened after SPGMI's forecast release, as did the 10% Section 122 tariffs that the administration announced. In this chart, we have SPGMI's forecast for GDP through the end of the forecast horizon. Here, the overall outlook has improved since November, with higher growth in 25 and slightly higher growth in 26, mostly due to an assumption that strong economic growth in quarters 3 and 4 of 25 would carry forward into 2026. As in November, GDP growth, though, remains below trend in 2027 and beyond. This means that employment demand is unlikely to be robust in the years ahead. Further, a low-growth economy can more easily slip into recession as a result of an adverse external shock. Real personal consumption expenditures, also known as real consumer spending, are the primary driver of growth in the economy, accounting for roughly 70% of GDP. SPGMI now forecasts real consumer spending will grow 2.8% in 2026, 0.7 of a percentage point higher than their November forecast. From 2027 through 2029, real consumer spending is expected to grow 2.2% per year on average. Despite rising incomes, we are observing some signs of consumer stress with higher delinquency rates in certain loans, credit cards, auto loans, and student loans, with delinquency rates now reaching levels comparable to those during the Great Recession. However, home loan delinquency rates remain at historic lows. Compared to the November forecast, inflation is projected to be slightly lower in 2026 and higher from 2027 to 29. Lower near-term inflation reflects a lower assumed average effective tariff rate than in the November forecast, and lower inflation that we experienced in late 2025. Overall, inflation in both the CPI and core personal consumption expenditure indices is expected to remain elevated through 2027 before gradually easing in 2028. Corporate profits are now forecast to grow 9.5% in fiscal year 2026, 7.4 percentage points stronger than projected in November. In FY27 and beyond, corporate profits are forecast to show minimal growth. Minnesota's corporate franchise tax is closely related to the level of corporate profits and is the state's most volatile revenue source. The volatility in this revenue source makes it difficult to forecast with precision. Minnesota's unemployment rate has continued to increase over the past year, both absolutely and relative to the national rate. In December, Minnesota's unemployment rate was 4.1%, up 1.1 percentage points from a rate of 3.0% 1 year ago. Although the unemployment rate has risen, Minnesota's rate remains below the national rate, and the state's job market remains favorable to job seekers, with more vacancies than unemployed workers. While this forecast does not include a recession, we are following labor market conditions closely, as some labor market indicators send early signals of economic contractions and expansions. Traditionally, a significant driver of our individual income tax forecast is the forecast for total wage and salary disbursements, and it is little changed since the November forecast. In this forecast, though, wage income is not what is driving the change in the individual income tax forecast. Rather, the increase is driven by increases in non-wage income, principally in capital gains distributions. SPGMI's forecast of the S&P 500 stock index is one determinant of our forecast for non-wage income. Their February forecast is substantially higher than their November forecast for the S&P 500. In November, they projected a 12% multi-year downward correction in the S&P 500, with the market declining through late 2028. But in the current forecast, they assume a milder correction of only 4% and recovery beginning in 2027. Equity markets present both upside and downside risks to the forecast. If equity markets continue their current upward trends, we will see greater levels of consumer spending and higher non-wage income, both of which will increase state revenues. On the other hand, if we see a substantial decrease in market values of equities, both income and spending would likely fall. So turning to the revenue forecast, the first two columns of the table show the February forecast for the current biennium and the change compared to the November forecast. The second set of columns show the same information for the next biennium. Total revenues for the current biennium are now forecast to be $68 billion, 1.8% more than in the November forecast. We're now projecting individual income tax receipts to be 1.9% more than we projected in November. This increase is primarily due to higher forecasts for individual income tax liability in tax years 25 and 26. The higher tax liability forecast is largely driven by higher forecasts for non-wage income sources, such as capital gains realization, interest income, and IRA distributions. Through January 26, individual estimated tax payments for tax year 25 are $165 million above our November forecast, which is consistent with a higher tax year 2025 liability. Technical adjustments and a higher forecast for net partnership and S-corporation collections further contribute to the forecast change. And this is also consistent with stronger collections we've observed through January of this year. General sales tax revenue is now forecast to be nearly $16 billion, 0.5% more than in the current biennium than in the November forecast. This increased forecast reflects a higher forecast for consumer spending on goods and services subject to the sales tax. The corporate franchise tax is forecast to generate $6.6 billion in the current biennium, 5.4% more revenue than in the November forecast. This forecast change is due to the higher corporate profits forecast as shown previously. Other revenues are now forecast to generate almost $10 billion, 1.2% more than in November, due primarily to an increased forecast for investment income, the return the state earns on its cash balances, including the budget reserve. As I noted previously, higher forecasts for non-wage income sources are primary drivers of the higher individual income tax forecast. The non-wage share of gross income reported by Minnesota taxpayers has been increasing over time, and we expect this trend to continue. Non-wage income, such as capital gains and interest income, are more variable from year to year than wage and salary income. With a rising proportion of personal income tax coming from more volatile sources, the overall volatility of income tax collections has increased. Further, over time, the proportion of general fund revenues coming from more volatile corporate tax, franchise tax, has also risen. This adds volatility to the state's revenue collections in total. To turn to forecast risks. First among the risks to this forecast are the policy uncertainties at the federal level, especially regarding trade, tariffs, and immigration. Trade uncertainty may induce businesses and consumers to take on less debt, suppressing both private investment and some forms of consumer spending. Tariffs are mostly passed through to domestic buyers and so also contribute to higher prices and higher input costs for businesses. The administration's immigration policies also produce forecast risk through the potential to create labor shortages in business sectors dependent on immigration for new workers. The recent federal shutdown disrupted the usual collection and dissemination of federal statistical data. The missing data due to the shutdown clouds our picture of economic growth, corporate profits, inflation, and labor market conditions, adding uncertainty to our revenue forecast. It also makes it more difficult to assess the reasonableness of SPGMI's forecasts of inflation and exchange rates. Equity markets present both upside and downside risks, as I've already mentioned. The assumed path of monetary policy depends on both inflation and labor market conditions. Because of the trade uncertainty and weak national employment growth, there's limited clarity about monetary policy through the forecast horizon. The adoption of artificial intelligence provides both upside and downside risks. The upside or positive risk is that through more capital investment, we'll see increased labor productivity, higher wages, and possibly higher employment. The downside risks include the possibility of job losses from AI adoption and the risk that there is an AI investment bubble which may burst. Finally, there are 17 months remaining until the end of the current biennium, and it's difficult to forecast macroeconomic conditions with great precision a year and a half ahead. That ends my portion of the presentation, so I will now turn things over to our State Budget Director, Anna Mingi.